Okay. Hello. Let's work on Worthy Lake question. So Worthy Lake sold used machinery to Brown Company, and they accepted a $25,000 non-interest bearing note maturing on January 1st, 2018. And this machine was carried at $22,000. The current book value was $15,000, meaning we've had depreciation of $7,000. Neither the fair value of the note was determinable at the time of the sale. However, we do know the borrower's incremental rate to be 12%. So we usually use the borrower's incremental rate if it's known. With that, we need to record journal entries for the sale of the machinery. So first, we did, from this sale, we got a notes receivable. So we have notes receivable of $25,000. We have accumulated depreciation that's on our balance sheet. We need to remove that. So accumulated depreciation, we get rid of that. The accumulated depreciation is the 22,000 minus 15,000. So we have 7,000 of that. And additionally, we are removing the machinery from our books, which was the cost was 22. So machinery is $22,000. We also have discount on the notes. For us to figure out the discount on the note, we have the note is at $25,000, but we can figure out the present value because we have the rate. So the present value of that note is $25,000, and we look for the present value factor under 2 years, because this is a note that's only for 2 years, and the rate is 12%. So we look under the two compounding periods, 12%, we have 0.797194. Note that we do use the tables in the middle of the textbook. We do not use, if you use your calculator, your solution will be off a little bit. So use the tables in the textbook when computing, when calculating questions. So this is our present value, and this is the book value. So with that, the difference is our discount, which is $5,070.15. Further, so after we've done this, on the credit side, we have this 22,000, so $27,070.15. On this side, we have 32,000. The difference is our gain on machinery. So the gain on disposal of machinery, or gain on sale of machinery, comes to $4,929. So $4,929.85. So this is derived from after working on those other factors there. The additional requirement, we need to do adjusting entries for December 2016 and 2017. So even though the note is non-bearing, is non-interest bearing, we still need to record journal entries at the end of the year, because we record the interest income and amortize the discount on the note. So for December 2016, so December 31st, 2016, we're going to amortize the discount. So discount on note payable, and record our interest income. So we have even though there is no cash payment at all, we still need to amortize the discount, and the amount is the last carrying value. So that's the present value from this computation. When we calculate this, that's going to be 19,000. So 19,929 and 85 cents. And we're going to calculate interest based on the 12% rate. So times 12%, that gives us $22,391.58. So that's also the amount of our amortization, $2,391.58. At the end of 2017, we also have another journal entry. So 12/31/17, we amortize the discount on the note again. So discount on note payable and we'll post the interest income. This time we're not using the 19,929. Now we've already amortized this, so we'll incorporate that into our calculation. So we have 19,929.85 plus the amortization from prior year, 2,391.58, and we multiply this by 12%. So 12% or 0.12 to get our amortization for this year. So we have $2,678.57. And that's the same amount here, $78.57. The last transaction in 2018, so we do need to record the payment of the note by Brown in 2018. So in 2018, this gets settled. So we have a cash inflow of the entire amount, the entire $25,000, and we remove the notes receivable from our books because we no longer, it's no longer a receivable when we receive, when it's all settled at the end. So note that the original amount that we recorded, and we had the two amortizations, that takes it to 25,000. So the 2391 and the 2678, if we had it the original 19,929.85, that makes it 25,000. So this will clear out of our books once we post that. So that's it for the requirements for this problem.